what is Relative Vigor Index indicator, and by the end of this session you should be able to understand what is Relative Vigor Index indicator, how to interpret and use the indicator. The Relative Vigor Index indicator, or RVI for short, is an oscillator based on the concept that prices tend to close higher than they open in uptrends and close lower than they open in downtrends. It is a momentum indicator used in technical analysis that measures the strength of a trend by comparing an instrument closing price to its trading range while smoothing the result using a simple moving average SMA. The Relative Vigor Index indicator is similar to the stochastic oscillator in appearance, but the difference between the two is that the Relative Vigor Index indicator compares the close to the open, while the stochastic oscillator compares the closing price of an instrument to a range of its price over a certain period of time. Let's look at the formula. The first step is to examine the current bar over an end period and identify its open, high, low and close values. Secondly, identify the open, high, low and close values for the previous look-back periods prior to the current bar and calculate the SMAs for the numerator and denominator over the end period. Divide numerator value by denominator value and place the result in the signal line equation and plot it on a graph. The Relative Vigor Index indicator is set to period 10 by default, but traders may change this according to their preferences. Now let's look at the features of this indicator and how to interpret it. RVIs consist of two lines, green and red. The green line is the RVI itself, whereas the red line is the trigger or signal line. Red line is a 4-period moving average volume weighted of green line, and it's used to provide trading signals when it crosses above or below the RVI line. Rather than having a fixed range and oscillating across a trend, the Relative Vigor Index oscillates across a zero line, going either higher or lower than the line itself. We'll go through the Relative Vigor Index indicator trading techniques in details on chart, and also how to use it with combination with other technical indicator. Let's begin with placing the Relative Vigor Index indicator on chart. To place the Relative Vigor Index indicator on chart, there is few methods to do it. The first method is go to Insert, then Indicators. Under the Oscillators, select the Relative Vigor Index. The second method will be the easiest one, as you click and drop it from the Navigator panel. To do that, simply go to Navigator panel, Indicators. Under the Oscillators, click the Relative Vigor Index, drag and drop it on chart. Now let's look how to use the Relative Vigor Index indicator in trading. There are three methods in which traders can use the RVI indicator during trading. They are identifying the divergence between the Relative Vigor Index indicator and the market. Second, trading the crossovers. Third, using the Relative Vigor Index in combination with other technical indicator. Let's look one by one in details how to use them. Bullish and bearish divergence. It is commonly used by traders to predict market reversal by looking at the divergence. A bearish divergence happens when the market making higher high, but the Relative Vigor Index indicator makes lower high. This indicates that the market is overextended and the rising power is minimal. Therefore, there is high probability that the market will tend to reverse in trend direction over the near term. A bullish divergence happens when the market making lower low, but the Relative Vigor Index indicator makes higher low. This indicates that the market is in oversold condition and the declining power is minimal. Therefore, there's high probability that the market will tend to reverse in trend direction over the near term. Here are a few examples of Relative Vigor Index divergence signals. Crossover. For crossover method, traders will look for the two lines to intersect and then execute a trade by following the major trend direction. This means that once traders confirm that a bullish trend is underway, they should go long when the RVI crosses over the signal line. Similarly, once trader confirms that a bearish trend is underway, they should go short when the RVI crosses the signal line. Here are a few examples of RVI crossover signals. Combination with other indicator. Not all RVI crossover signals is enough to predict a reversal. For this reason, it is often used in combination with other technical indicators such as moving average that define the market's major trend. One of the easiest and most common ways is to simply look at the market's 200 moving average. This means that traders should only focus on taking long position when the market is above the 200 moving average and wait for the price to come back to the 200 moving average and make a bounce. And at the same time, wait for the Relative Vigor Index to make crossover in order to go long. Similarly, traders should only focus on taking short position when the market is below the 200 moving average and wait for the price to return to the 200 moving average and make a rejection. And at the same time, wait for the Relative Vigor Index to make a crossover in order to go short. Here are a few trade examples that use the Relative Vigor Index indicator in combination with moving average.